Good morning, good afternoon, or good evening wherever you are from. Welcome back to a new episode of Daily Insights. Before we start, please subscribe to this channel and hit that bell icon. Without any further ado, let's get started. Did you hear about that secret exposé on Tiger Global? In case you haven't, in today's episode we are going to explore what the exposé reveals about Tiger Global. It's an anonymous 9-page note that threatened to spill the beans on one of the biggest private equity-cum-hedge fund firms in the world. There were whispers that it was a draft of a story that the New Yorker was working on, and that Tiger Global was even trying to stop it from being made public. So, we got our hands on it, because we were curious too. And what did it say? Here is the gist of it. Apparently, people who have invested money with Tiger Global are unhappy. They are trying to withdraw their money. So the firm is succumbing to this pressure and trying to find buyers for many of its startup investments. It allegedly took money from its public market fund that invested in listed companies and funded startups that were private. And when people wanted money back, Tiger couldn't sell the private investments easily. The US regulators are looking into them for intentionally deleting internal emails that were about trying to find ways to squeeze more fees from their investors. That's not a good look for Tiger Global, right? But here is the thing. It turns out that the memo is likely fake. On Saturday, Tiger Global refuted the authenticity of the note. They said that a disgruntled former employee was simply trying to stir the pot. And then the New Yorker poured cold water on it by denying the fact that it came from their stable. The whole thing was quite anticlimactic. So you might be wondering now, if it's fake, then why are we talking about it? Well, here is the truth. The memo might be fake, but the exalted PE firm has been in a spot of bother for a while now. Also, it's a story of the trials and tribulations in the private equity world. Let's take it from the top then. Before Tiger Global, there was Tiger Management. In 1980, a fund manager named Julian Robertson set up a firm to buy companies listed on the stock exchange. His strategy was simply to buy undervalued stocks and sell overpriced ones. And for 20 years, he delivered superlative returns in his fund, 25% every year. He became the stuff of legend. And it's that staunch belief also led to his downfall too. You see, he didn't touch tech stocks during the tech bubble of the late 90s. And when rivals were sitting pretty, his fund was down and out. Eventually, he decided to pull the shutters on his glorious career. And when he wound down his fund in 2000, he passed the baton over to his proteges, aka the Tiger Cubs. They were to go out into the world and set up their own firms. And out of that emerged Tiger Global, led by Charles Payne Chase Coleman III. Robertson even seeded him with $25 million so that he could hit the ground running. Now the strategy was the complete opposite of what Robertson had stood for. Tiger Global didn't care about price. They were aggressive and would go after anything they believed had potential. And they weren't early investors either. They would come in at a later stage. They would buy private and public companies. They even used their multiple funds to control the playground. For instance, they'd back one company with their VC fund. And just before the IPO, they would use their hedge fund to pump in more cash and drive up valuation. For a long time, this worked. It looked like everything they touched would turn to gold. And as their legend grew, they attracted a lot of cash. They managed over $95 billion across multiple funds. Tiger Global was at the peak of its game. But not everyone was happy. Behind closed doors, other VCIs were kind of disgusted at how Tiger was distorting the market with its cash pile. And last year, everything turned topsy-turvy. Tech stocks crashed, both in public and private markets. All their funds received a beating. And Tiger Global's funds lost over $40 billion in value. It was a massive loss. Some say it was the highest the industry had ever seen. Alongside this was another set of complaints. Apparently, the firm was indulging in a practice that many consider unethical. They would raise Fund A and invest it in a company. Then it would raise Fund B and invest more money into the same company. And with each new investment from their stable, it would bump up the valuation. And this would make the older fund look good on paper. And investors weren't happy with this outcome. So when Tiger Global tried to raise $6 billion for a new fund this year, investors gave them a cold shoulder. They didn't write out the checks. And the fund just about scrapped together $2 billion. Tiger Global's row was turning into a soft purr. Now here is one more thing. The media reports are talking about how Tiger Global is indeed trying to salvage its reputation and offload some of its portfolio investments. It needs to find buyers on the other side too. But it's not going to be that easy. A finance lecturer at Wharton, David Erickson, has two theories to explain the state of the private equity industry today. Firstly, he thinks fear of missing out has given way to don't want to catch a falling knife. Bubbles are caused when people have a fear of missing out. They don't do the due diligence. And they rush into the deal. Because they think the wisdom of the crowd will work in their favor. But it doesn't. He points out that after crypto firm FTX collapsed last year, private equity firms became the butt of all jokes. Because they were fooled into investing at higher and higher valuations as each month passed. Sequoia Capital even penned an apology letter to their investors. And that's just one example. Startup valuations are dropping quickly. And pay investors don't want to catch this falling knife. They don't want to be scarred further. So they're not going to be in a rush to buy what Tiger's selling. Secondly, you have to remember that pay firms don't conjure money out of thin air. They have to convince big investors or families with money to trust them in making investment decisions. These investors are called limited partners in PE lingo. And apparently, large LPs have a trust deficit now. They want to be more involved in the PE firm's portfolio decision making. They want to see the due diligence and speak to the startups themselves. They want the veto power on investments, stuff like that. And that could prove to be a roadblock for Tiger Global too. So secret exposé or not, times are changing and it looks like Tiger Global is losing its fans. Until then, have a nice day. If you like this episode, then give a thumbs up. Don't forget to subscribe to see more such insights. Thank you very much for tuning in, and I will see you in the next one.